So I got asked by an investor the other day about the difference investing in multifamily syndications versus crowdfunding platforms. Now, these crowdfunding platforms have become, quite popular over the last number of years. Platforms like Fundrise have become really big. So what I thought I would do is make this video and talk about the key differences you need to understand between investing in real estate deals on crowdfunding websites like Fundrise versus investing into specific multifamily syndications. So if you've been kind of toggling between these two options or you want to know more, make sure you check out this video. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I get into the meat and potatoes of this video, two super quick things, guys. Number one, if this is your first time on my channel, first of all, welcome. I'm a multifamily investor here out of Boston, investing all in multifamily all over the country. And number two, guys, if you've been thinking about investing passively in multifamily to create an additional income stream, increase your wealth, get that equity upside, and get tax benefits, make sure you click the link below in the description, set up a call with me and my team, and we'll be happy to talk to you guys if investing in our multifamily syndications is something that could be a good match for your investment strategy and portfolio. So with that, let's jump right into the content. And as I said, what I wanted to do was really break down the differences between investing in crowdfunding sites versus multifamily syndications. So let's start with the first, which is crowdfunding. And the first obvious advantage of crowdfunding, and why a lot of people really like it, is you can get real estate exposure in a portfolio for really not a lot of money. A lot of these websites have minimums of maybe a couple $100s, right? So, for $400 or $500, you can go invest in a real estate deal and get real estate exposure in your portfolio. Now, the other thing that's really nice about these crowdfunding sites is that they sometimes actually offer different types of investment structures, right? So they offer, you can certainly invest as an equity investor, right? Meaning you get direct ownership in that real estate. You can also invest as a debt investor, right? Where you're giving a real estate operator basically a loan, right? And they're paying you back a concrete amount of interest on your invested capital. Now, if you go on these websites, you can scroll through all these different types of opportunities available. And what's cool is you can find a bunch of different types of opportunities in different types of locations, different types of asset classes all over, right? So, you can invest in ground up development, you can invest in existing multifamily, you can invest in other asset classes, right? So these websites do a really good job in providing a large, broad spectrum of different types of opportunities. Now, let's talk a little bit about income, right? So of course, if you guys are thinking about investing, probably one of the main drivers is you do want another stream of income coming in. And when you invest in these crowdfunding deals, they do typically pay out some sort of cash flow. Now, these cash flows are typically paid out as dividends, which is nice, but what you need to understand is since they are paid out as dividends, they will be taxed as ordinary dividend income, which can actually increase your tax liability at the end of the day. Another thing to know about these platforms, a lot of them do have strict rules about potentially cashing out your investment early. Right, a lot of them do have certain types of minimums. Sometimes it's a couple of years, like 2 years, sometimes longer. And then if you do want to cash out your investment early, if you're allowed to, then you might incur some sort of penalty, etc. So, the flexibility is somewhat there. Sometimes it's a little bit more rigid, but you just have to make sure you do your homework about, how early can you exit a deal if you need to do so. Now, the last point I'll make about investing in this, that is something to consider is, at the end of the day, when you're investing in any sort of deal on these websites, one thing is you don't necessarily know who the operator is and the full extent of the resume, experience, the quality of work they do, or the reputation they may have in a given marketplace, right? Now, of course, these platforms, I'm sure they do try to vet and do their best to make sure only quality operators do get on. But at the end of the day, you don't necessarily have a pre-existing relationship or really know who the operator is. So there is some uncertainty within that aspect that you definitely need to account for. But at the end of the day, as you can see, crowdfunding is a great tool, right? Because you can get real estate exposure for not a lot of money. You do have a really broad spectrum of different types of opportunities between different locations, asset classes, different types of projects. So there are certainly some great advantages in going the crowdfunding path. So now that we covered crowdfunding platforms, let's move over to syndications, right? And multifamily syndications structurally are pretty similar to crowdfunding, right? At the end of the day, you're getting a bunch of investors together who pool their money, and you're going to have an operator who takes that money, uses that money to buy a property, and the operator runs the show. Now, here's some of the key differences with multifamily syndication. Number one is the amount of capital required, right? So as we talked about with crowdfunding, you can typically get exposure for as little as a couple $100s. Syndications, you typically have much higher barriers to entry, right? Most syndications have minimums of $50,000. Sometimes they're even as high as $75,000, $100,000, or even $200,000, depending on the deal and the operator. The good thing about syndications too is typically returns are much higher on a multifamily syndication than on a crowdfunding platform, right? Because these multifamily syndication structures have been around for a long time, and they were literally built to essentially help deliver strong returns to the passive investors, who invest in the deals. Not only that, but you also get a huge tax benefit when investing in syndications as compared to on the crowdfunding side, right? Because on syndications, what happens is income and depreciation of the property actually pass through to the individual investor, right? So basically what will happen is each passive investor, every tax cycle will get what's called a K1. And what happens is if the property is essentially able to claim a loss on paper, right, due to things like depreciation, you can obviously, of course, have now bonus depreciation. I won't get too into much of the details, but essentially it allows you to claim even more depreciation up front. If there is a negative loss on the property, that loss will flow through to you as a limited partner in that deal, which means that it can actually help you shelter some of your tax liability from your other sources of earned income. So there's obviously financial benefits. Now let's talk about actually, the relationship between you as the passive investor and the operator. So with syndications, right, there typically tends to be a much stronger relationship and trust between the passive investors and the operators, right? Because typically you invest with someone that or you've connected with, or you followed, right? So you kind of have a much better idea of, look, this is the group I've been investing with. This is, this is their experience. I've heard this is their reputation in the market. This is the kind of work I've seen them do in their other projects, right? So basically you're investing with someone that you have a lot more connection to and trust than just maybe something that's a little bit more blind on the crowdfunding side. And the other thing I'll say too is operators here tend to be much more specialized and niche down than, if you were to go on the crowdfunding side, right? Because we talked about on the crowdfunding side, you do have access to a broad spectrum of deals, which can be good. But on this multifamily syndication side, you typically invest with operators that specialize in certain niches, right? A lot of times it's, people will focus on multifamily, maybe in a couple of markets, or maybe in 3 different states or something, right? So if you want exposure in, let's say, multifamily in Miami or multifamily in Phoenix, right? You can connect with an operator that has experience in those marketplaces, that already has an operation, that owns some units, already has construction and management all in place, right? So you're investing into a much more sophisticated operation for the type of exposure that you're looking for. Hopefully that helps, right? Hopefully that kind of gives you an idea of, some of the key differences between the syndication structure versus the crowdfunding side. Again, I don't think there's a right or wrong answer. I think a lot of it depends on, your goals as an investor, how much targeted exposure you want, and then ultimately how much capital you have to invest. So hopefully that's helpful, guys. Of course, like always, if you guys have any questions, make sure you put them in the comments below, and I will definitely help you